Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today it's Friday, so we're doing a head-to-head, and we're looking at two companies in the construction, consulting, utilities space, and these are Dycom Industries and Primoris Services Corporation. So Dycom mostly deals with telecommunications, but they do a little bit of gas and sewage, while Primoris is almost specifically within the energy pipeline service sector. But there's a bit of overlap here, and we'll just see of the two which one's a better buy. This was requested. There is a whole list of requested head-to-heads. So next week, there might be quite a few of them. And I'm actually thinking of putting together a bracket of some of the top stocks on the market and see who comes out on top. Maybe over the course of a week or a month, we'll just go head-to-head and the winner moves on to the next round. So drop some tickers down below for companies that you'd like to see as part of that. So for these two, we'll start with the financials as usual, and we'll start with revenue per share. All of these numbers are on a per share basis, so that way we have more of an apples to apples comparison, and you see that your one share of DY fetches quite a bit more than your one share of PRIM. We see that DY is higher, and they've been holding higher, but PRIM is kind of catching up. They definitely have a much better trend, although DY has a better value. And that's what we're looking at here. Value and trend, we'll see who has the best financials at the end. Cost of goods, of course, this is almost always the case unless one of the companies has much better margins than the other. We see that DY has higher cost of goods, and therefore it goes to PRIM because we want a lower cost of goods. The trend is going to DY because apparently they are not growing theirs as quickly. For gross profit, DY is winning, and honestly, that looks like a better trend there, and that is the case. And for the gross profit percentage, looks like DY is holding between 16 and 18%, while PRIM is essentially flat, close to 11%. So we're going to give the value to DY, but the trend to PRIM, because apparently they do see some more growth over this time period. Expenses per share, we see about what we would expect with PRIM winning. DY has a bit better trend. Expenses as a portion of revenue, there's some crossover on this one. So PRIM is winning. At least as of last year, they're lower on the expenses as a portion of revenue, and DY has a better trend. Net income, we see DY is kind of all over the place, and PRIM is consistent and growing. Again, we're looking at a DY win, PRIM loss. Net profit percentage, again, we see consistency with PRIM, not so much with DY. PRIM is winning. They do have a better trend and a better value there. And earnings per share, DY has been growing this very nicely, while PRIM very slowly. So DY is winning both there. Earnings yield, this almost looks like a perfect little shape here between the two of them, but clearly PRIM is winning and has a much better trend. So for the financials, we don't have winner. We actually have a tie because for both value and trend, they each won half of them. I'd say of everything, the net profit percentage is probably one of the most important things. So the fact that PRIM is very consistent and better at growing that, and the revenues, if we look back up there, PRIM is better at growing that. So PRIM looks like a better growth stock when it comes to financials. And then the rest of the metrics to compare between the two. PRIM has a lot more shares, not quite twice as many, but they do have more shares. DY has been buying shares back while PRIM has been growing their share count. So DY wins on both of these. We really do like to see companies buying back shares. So definitely get a little bit more weight for that. And that could be helping some of their financial numbers over here as well. Shareholders' equity, DY is winning, but they're flat. They haven't had a whole lot of movement in that, while PRIM is growing theirs pretty quickly. So soon enough, PRIM can take over. I mean, if they can continue at the pace that they've been going, we can see what it would take for them to win out. So it looks like it'd probably take about 2 years, and all of a sudden they would be first place there on current value. Yes, 2 years, and they'd be winning on current value. Free cash flow, both of them are negative, definitely not what we want to see. The free cash flow is probably one of the most important metrics for a company. So I do not like seeing that on either of them, or for the free cash flow. Free cash flow yield, PRIM's essentially breaking even, but they do win there because DY is negative. And again, we have very similar numbers for the trend. Assets, DY is winning. They're winning there on book value and on debt to equity. Both of them have pretty high debt to equities. Definitely not what we're looking for. We want something under 1. And PRIM is winning on liabilities and cash per share. So they're really close on liabilities. There's a bit more distance on the assets. So it looks like DY's balance sheet is definitely in a much better place, aside from cash. PRIM is pretty heavy on cash, and they've been growing it pretty quickly too. So when it comes to actual growth of these numbers, we're seeing PRIM win out here. They're growing their cash, their assets, and the one issue is their book value is shrinking, and it's probably with how quickly they're growing their liabilities. So it's a tough one here. I think I'm going to have to give it to DY again for the balance sheet because it's in a much better place. And the issue is how much faster PRIM is growing their liabilities. I mean, they're growing their cash even faster, but that's definitely a smaller number to begin with. So they're tacking on a lot of debt. Dividend, DY doesn't even pay a dividend. PRIM didn't even start until halfway through last year. So there's really not much to say about any of this. Very small yield, nothing to bank off of for either of these stocks. Share price, of course, PRIM is much more affordable. If you want to buy 100 shares, do some covered calls, PRIM would be your winner there. The thing is, they're essentially flat over our time period. So over the past 4 years, not a whole lot of movement in PRIM, while DY has been putting up some really good growth year over year. ROE, we do like to see it above 20, 16.4. It's not awful, but with a P or a debt to equity ratio above 1, we know the dilution is playing into this. So neither of these companies really have good return on equities. And for PE ratio, I'm surprised PRIM is so low. DY is right around the 20 that we typically see for stocks. And we just want to see it pretty consistent because that'd mean that the market trades pretty well in line with growth expectations. And consistency here would go to DY. So what are we looking at across the board here? For the financials, I mean, it was a tie. I do think that net profit and the expenses as a portion of revenue are very important. So we can tell that DY is improving on their expenses based on the trend here, but their net profit percentage is telling a whole different story. So due to consistency, I think we're going to have to give PRIM the win. On the balance sheet front, only thing PRIM really has going for it is the lower liabilities and the higher cash, but they're growing their debt a whole lot faster. So that's probably not even going to be the case within a year. So we're going to have to give DY the balance sheet. PRIM does win the dividend because they pay something out. Personally, I would not be buying either of these companies, but if I had to pick one of them, part of me really wants to say Prim. They're better at improving their margins, driving revenues, and that's going to help flow through all of these numbers here. Looks like they're investing pretty heavy into something, and they do have quite a bit of cash. My biggest issue with them, a few of them, they are growing their share count, and their share price has been flat. ROE is low and worsening, and it already has a really low PE, so the market is already not really believing in the company. Yeah, I'm going to have to give it to DY, though, because the debt to equity is probably one of the most important factors here. Prim is just putting on too much debt, at least from a value standpoint. If you want growth, Prim is definitely a better growth play here. DY is definitely a better. DY is more of your established typical stock in the market. And well, that's what we're looking at for this one. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment if there's any other stocks we should do a head-to-head on. Let me know what needs to go in that bracket. And subscribe so you can stay up to date with everything. And I'll catch you next time.